Okay, this is Brian Stoll for Timing Strategies, Wednesday, December 12th, '07. No need to go over the news and all the effects or whatever from the news. You can read about that as much as you like anywhere else. The Fed, though I will make a comment, has been manipulating this market for the last how many months or years? I mean, ever since the plunge protection and the working group was established. But they're really getting craven about it in this later stages. Especially our Treasury Secretary and his just pervasive effort to try to just put things where they don't belong, as far as I'm concerned. We have been short as of the 10th on Monday this week. You check our other videos. What I'm looking for is how to actually get short more without risking too much capital. Because the Fed, they got a lot of money. In fact, they got all the money they want. They could print as much as they like. We could see a jam job above the highs of yesterday's Fed meeting, which would take us above our regression channel. And in that situation, everybody and everything would have to pretty much get long again. So how are we going to manage this going forward? Well, based on the open and the close tomorrow, if we get an open within 1/4 to 1/2% lower than where our close went out today at, what I'm looking for potentially, my first case scenario is a trade or a move back up into the range of today that for the most part just comes to the barely to the highs of that range. As closer we can get, the better, and the closer it closes or just trades off that, the better yet. At that point, we will anticipate potentially getting short more so, because again, we are short 40% as of Monday. Second case scenario, and again, anything can happen. If we wipe out wherever we open, if we wipe out the lows of today, and we take out the lows here that we've been looking for, that we were looking for yesterday on the S&P using the spiders, at about 1460 or 146 on the spiders, then based on the close of that daily price, whether we go lower and close lower or whether we just stab it and then head higher, will determine what we're going to do with our short position as well. But again, this is where the art comes in, because and art and discretion, because all technical indicators, all our algorithms, all systems, trend following, short-term and regression analysis become so worth much less because of such intervention and such manipulation. The Fed can come in and instead of throwing $40 billion into the credit market, they can throw $10 billion into the stock market, and they can do what they did this morning. Again, it was a cheap shot in my opinion. They did it overnight. They jammed it on thin volume. And the market is starting to become less and less afraid of the Fed, and market forces are now becoming stronger. And so that, again, just shows what happened when we got the sell-off today. But again, the Fed can come in and pull that same stunt again, and they can move markets for days, weeks, sometimes even months, obviously. But for 1 or 2 days, that can equate to 2, 4, 5%. And we don't want to be on the wrong side of that when that happens. Ultimately, that manipulation fails. And anyway, we'll see. But again, based on how and again, we'll have to follow this day by day to let you know what we do. But here's where the discretion and the experience comes in to play more so than just our algorithms and our systems. What I do want to bring to your attention is what I anticipate happening. And this is just a guess. All things are a guess. Is that if we do, again, take a lower opening and move it higher into the close. That's my first scenario that I anticipate happening. What I do look for, because we're going into Thursday, Friday, I look for the S&P to close somewhere right about last week's closing level, anywhere between right about there on the spiders, at about 1500 on the spiders, all the way potentially as high as right about here. On the daily price bars of about 1510, 1520. So anywhere between 1500 and 1520 is where I look. My first scenario to basically end the end of the week. And the reason why I give you that as a preferable or more desirable, more likely outcome, and I don't know what's going to happen, but this is my first, what I'm looking for, plan A, is you look at the weekly chart. markets tend to want to revert back to the closing price of their weekly close of the previous week. And that right there equates to about 1500, 1510 on the spiders. Because we're going into the end of the year, the Christmas holiday season, nobody wants a bah humbug Christmas. And the Fed especially, because they know spending is contingent upon this sort of thing. I really anticipate that, again, my more desirable, more preferable scenario to manage things and what I'm looking for over the next 2 days, Thursday and Friday, is a close, the market to move back up to the close of last week, which is again right around 1500, 1510 on the S&P cash, or 151 on the SPY, the spiders. The other point, really to bring up here is the Fed is creating inflation while denying it. Literally, if you look at the oil market, sorry about the delay. If you look at the oil market, the involvement of the Fed in printing money to save a bunch of worthless paper and junk, credit markets and so forth, and again, in a very cheap shot, overnight, thin market environment to try to, take advantage of a cheap shot while everybody's sleeping in low liquidity, is creating this, ramp up in oil, in the prices of oil. So again, this is what happened when the Fed does what they do, and the bubbles start showing up, and it doesn't matter what the financial markets do, because pretty soon if oil hits 100 and then 110, 120, it won't matter. People won't care about stocks. People will not care about stocks and bonds. They'll look at their gas pump and they'll go, what are these people doing? If you look at the GDX, I'm still bearish on the gold paper. On the gold stocks, and again, I could be very wrong. This is a coin toss on this one. That's why I'm kind of staying out. The gold metal itself, it's setting up for what I believe, again, like I mentioned in a couple of other videos, either a breakout and a close above that 81 to 82 level. And what we need is a daily, weekly, so Thursday, Friday, close above that 81 level. I'd preferably see it close back above 82, and yes, I will get long, although a smaller position. But again, I am seeing that the potential for this gold to really get ripped lower, in the face of a potential deflation and sell-off, indiscriminate sell-off, would be a much more preferable place to get long, because then the Fed's going to print more money, and then, it's a safer entry. We can put on more size. Other than that, the dollar, the bond short that we have on, $cent TYX, the bonds got sold heavy today, but they came back in a little bit later. Still looking for the top of that regression channel, somewhere around 4.6, 4.75 for the 30-year note yield. We still have our bond short on. And again, not much to speak of, except, the Fed doing their, sticking their finger, jamming their finger in the pie, and so it just becomes a lot more tepid and more discretionary at that point. Feel free to give us a call or an email, and we'll keep you updated tomorrow. Merry Christmas, Happy Hanukkah, and good night.